What's up, everyone? It's your boy Looney back with another real one. Today we're talking about selling cash secured puts, a strategy I use almost every week, and whether it's still safe with all this market volatility. Before we dive in, quick shout out to the Discord community. It is free to join, and then there's also premium perks with my real-time trades, coaching, and full courses. You could check it out. All links are in the description. Now, let's be real. The market has been wild. We have seen ups and down. There has been massive volatility. Earnings season has thrown some curveballs as well. The Powell debate, the tariff debate, with all the ongoing macroeconomics has truly made this a unique environment. So, is selling puts still smart in this environment? Now, I personally believe yes, but only if you're managing your risk correctly. So, selling cash secured puts works best when you're okay with owning the stock at the strike price, but if you're just chasing high premiums without looking at delta, support levels, earnings dates, or even the VIX or Bollinger Bands, you're basically gambling and not really trading. Now, let me just show you what I'm doing. I have some cash set aside. I have $1,500, and then my total portfolio is sitting at that $39K. But as we move down here, I do have a ton of options. Majority of them are selling. I'm doing option selling. Now this video, I'm focusing more on cash secured puts, but I do also sell covered calls. And year to date, I'm actually up 18% despite my actual portfolio being down 8%. So it's definitely helped out with boosting my returns. I'm hoping to be positive in the future, or at least in this year. Now, the cash secured puts I have going on are the Riot $6.5 put, and then we move down more. I have a SoFi $9.5 put and a $6 Riot put, and I believe that is it. Oh, and a Mara $11 put. And this one, for example, I collected $51 in premium, went into my buying power, and I could do whatever I want with it. And on this trade, I'm up 37%, and I'm just waiting till expiration. I'm going to let this expire, collect the full premium, or at least have the return or the profit be realized, to have a realized gain. Because although you collect the premium at first, it takes a while, or it takes theta to decay and actually realize these gains. So with high premiums, you do come with high risk. And I personally have been looking at the lower deltas, ones that are below that 30 delta, and I'd rather collect that safety income than recklessly trading. And that's what I've been doing. I've been very cautious with these plays. And like I mentioned before, I am keeping cash on the side. I'm not using all my buying power just because the premiums look juicy or really good. If the market does dip and it continues to dip, I will at least have the funds to actually buy the shares and not get overexposed, and just overall be prepared for those dips, because if Riot, Mara, or SoFi does dip even further, I could sell cash secured puts at even lower strikes and collect premium and basically do dollar cost averaging on options. Now, I also I'm investing in crypto and stocks, but we're just going to focus on the selling puts. That's why my portfolio is down 8%, is mostly because of what I'm holding, not really the option trades. As you see, I'm up 18% from the day, year to date. So here's what you need to keep in mind when selling puts in this market, or just the market in general. Number one is to use lower delta puts. Anywhere from that 20 to 30 range does help with avoiding surprise arrangements, because that 20 to 30 range means that there is a 20 or 30% chance that you get assigned and be forced to buy the shares. And having assignment isn't always bad. You actually want to get assigned, but at least that $20 that 20 delta and 30 delta allow for big dips or declines in your stock or your position. Now, number 2 is I don't always follow, but avoid earnings weeks unless you really want the share. So during earnings, the stock's volatility is really strong and really high, and you could get hit with volatility crush. That's more on the buying options. But when selling options, the stock can move up or down in a massive direction. And you need to be okay with that volatility. And that's why if you're new to it or just want to be on the cautious side, avoiding earnings weeks is actually not a bad play. I'm sort of doing that with Mara because I do want to sell a put on Mara, but I want to see how the stock does for earnings because I believe it's not going to do as well, especially because Riot had earnings and missed earnings by a ton. And Riot did dip. It didn't massively dip, but it did dip. And I'm looking to sell Mara at lower strike prices. Now, number 3 is to watch VIX. Now, again, the reason I look at VIX is because of my allocation of cash. Now, I'm always selling puts, I'm always selling options, no matter what the VIX is or just the overall sentiment. But VIX does help when volatility is high and premiums end up being inflated and just an overall good time to sell options. Now, right now, VIX is at a pretty normal level, sort of towards the high end of things, but overall, you don't want to go all in on positions until VIX is above that 30, 40 range, which we saw this year on April 8th. It was at 52. And that's when I personally actually went into a lot of positions, either buying calls or selling puts aggressively, and just overall being invested during that time when the VIX is high. That doesn't mean you shouldn't be invested when the VIX is low. You could play a little different when the VIX is low. You could be a little bit more cautious. You can do different plays, maybe even buying puts. I'm not personally doing that right now, maybe in the future. But there are different strategies you can use when the VIX is low. You don't have to just stay on the sidelines. Now, number 4 is very important. This is probably one of the most important things, is to target stocks you believe in. So when doing these kind of strategies, selling puts or selling calls, picking the stocks is very important. Whether you're doing Ford or Riot, you need to know what price you're okay with owning it. I like to study the stock for a little bit and just overall see where it trades. I know Riot is pretty wide with where it trades. It trades anywhere from that $6 to $12. And that's why I was okay with getting assigned at $9, $10. Obviously, I'd like to get assigned at lower costs, and that's why I'm selling even more puts. But you need to be aware of where the stock trades, especially on a long term. And just overall having conviction or long-term outlook on these stocks or just whatever strategy you're going for. I'm very long-term on SoFi, Riot, and Mara. So I'm okay with owning the shares at a slightly higher price and perhaps get even lower with dollar cost averaging. But picking stocks is very important. That's probably the most important step when selling options or just any strategy you are doing. Now, number 5 is something I don't do with selling puts. I do it with selling covered calls, but that is rolling early if needed. With rolling, it lets you adjust with price movements and just overall movements, and you don't let your trade go in the money if it wasn't your plan. Now, going back to the original strategy, you need to set a plan, and if things go wrong, I don't roll selling puts because I pick strike prices that I'm very comfortable with owning and owning at those prices. But covered calls, I do roll, and this way I get stock appreciation and perhaps some kind of extra income when increasing the strikes. Now, the bottom line is yes, selling puts does still work, especially in volatility. Right now, if you manage your risk, you should be very strategic, stay disciplined, and keep building your portfolio the smart way. Drop a comment. Are you still selling puts right now, or are you just sitting on the sidelines? Don't forget to like, subscribe, and hit the Discord if you want my full breakdowns, live calls, and coaching. Until next time, peace.